Hello everybody. So in this video, I'm going to be showing a trading model example. So it's one that works for beginners. It's part of a series of videos I'm doing specifically for gold. So please check my channel. You will see other videos related to this topic. So it just makes things a little bit easier to understand. So this is all based on the two-step model I talk about. So there's two steps. There's your direction step. So in this example, I am on gold and I'm using the 20-hour time frame. I use the higher time frames for these videos because they make it easier to explain. With the lower time frame, there's a lot of price movement. So we have this level here, which is point A. We have this level here, point B. We have this level here, point C. That's it. The first part, which is this part, is your direction or your impulse, your A to B leg. That's the first part. Once you see this part, every time you see the first part, you always know there's going to be a second part, which is your retracement or your corrective leg. That's your B to C leg. That's it. That's the two step. First step, AB, second step, BC. No indicators, just price. Now, it helps to understand overall trend and it helps to understand where you are in the context of the very large time frame. So the weekly, monthly, etc. But just for this price movement between this point and this point right now, this is live, we have a two-step. This is an example. A to B direction, B to C retracement. What are we looking for at point C? Well, some other things I look for. First, fib. Take your fib, you can draw it out. Just going to change this to a different fib. Just going to use the swing grades, right? It's going to go to a fib. Now, preferably you want 50 or lower, but it can go to any fib, the retracement, depending on how fast price is moving. So that's the first thing. Now we need other things that give us an edge at point C. The other thing I look for is SMT. Now, this doesn't always happen. Okay, it doesn't always happen. And it can vary from time frame to time frame. It could be on any time frame. 4 hours, 1 hour, 15 minutes. You can get SMT. But that really helps. It gives you a little bit of an edge. So a point C, which we know has not gone past point A, okay, that's the main difference between your impulse leg and your corrective leg, we have SMT. So in this case, with silver. The final part to that is just a structural reversal. So in the last video, I will put a link to it. I talk about the three different modes or categories of reversals. There may be more, but the three main ones is the mushroom reversal, a head and shoulder type reversal, I talked about, and a V-shape reversal. Those are the three main reversals that you'll see. So if you combine SMT, fib, reversal, you've got three key data points that you can use to determine if point C is high probability to take a trade. Now, there are other things you can add to that. You can add fair value gaps at that level. Is there a fair value gap? Is there also a key level in terms of volume profile, for example? So if I take my volume profile and I run it from this high, say to this high, you can see that level, see, overlaps with the point of control. So there's a number of things that you can add to your sort of data bank to determine if point C gives you high probability for a chance of a reversal. Once you have that reversal, what are you targeting? 100%. So you take the fib, same fib, you run it from the low, and what are you targeting? 100%. Does it have to reach the 100%? No. It can go close to it, it can reach it, or it can go slightly beyond it. The key here is you need to be a little bit flexible here, because if you have any reason as to why price may prevent it from going higher, make sure you protect your trade. So in this example, if we go to the daily, you can see there's a fair value gap right here. We're running into that fair value gap. That can prevent prices. So I would just cut my trade and just get out now, right? Because that's the target above it, but we are in that fair value gap. There is just no need to take the risk. Now on the 1 hour, we can go, and one of the things we can watch out for is we see, if you see a structural shift, you can then exit your trade. There's a number of ways to manage your trade. The key here is the two-step. Okay, it's really simply direction, retracement. At point C, you start to hunt for the trade. I prefer to look for trades at point C rather than here when price breaks point A. It's far more difficult because sometimes price will run to the target, sometimes it'll give you an entry. So in yesterday's video, I was talking about the probability of taking an entry here. Why am I talking about that? First of all, the overall trend, so if I scroll out, at the moment is bearish. So in the context of that bearish trend, what is this movement from here to here? It's a retracement. That means from this level here, point A, to this level here, point B, that's the directional move, the first step. We are doing nothing. And what happens after the first step? Retracement. So that means this move from point B to this potential move, point C, is a retracement, a bigger retracement. So we can do the same analysis. You take your fib, run from this point to this point. You want it to be above the 50. Doesn't always reach the 50 if price is moving quickly. Now, at this point C, what are we looking for? We're looking for preferably SMT. We're looking for a structural shift. We know we have a fair value gap right there. Okay. And you can also use the volume profile. So if I take the volume profile, grab it from there to this point, so the swing high to swing low, right? We can use that. Where are we? We're in that fair value area. Okay. We're not at the point of control, which is all the way here, but we're in the fair value area, right? So the depending on how you use your fixed range volume profile, we've got these low volume nodes, which is overlapping, okay, which is important. There's the point of control, and then there's of course your higher volume node. So all of these things come together to give you the probability of taking a short entry. For me personally, I will be tracking the 1 hour, and effectively what I'm looking for, like I said, are those specific things. Once I see the structural shift, then I'll be looking to take a short entry. So this is just an example of a two-step in action. Step one, step two, profit. That's it. No indicators, no unnecessary analysis or strategies, complicated thinking. This just keeps things really, really simple because it's structural. Price is always moving in steps. impulse step, then it has a corrective step. Impulse step, then a corrective step. That's all price is doing. Impulse correction, impulse correction. Once you understand that it's always doing this, the trick or the skill is now trying to figure out when it's correcting, where is it going to stop, and what are you looking for to then take advantage of it. You are not always going to be correct. But the key here is, even if you're not correct, you have additional information that then tells you whether or not that leg is actually a correction or a retracement or a directional move. So if you didn't take the entry here and price broke here, you know that this was correction. And this is just a delivery of this move. This point C to D is just the delivery of point A to B. That's all that is. It may reach the 100%. It may stop just before the 100%. It may even go higher than the 100%. This is the easiest way of understanding targeting. Now, there are, of course, other ways you can apply. You can apply Bollinger Bands. You can do all kinds of things. But I'm trying to explain this in the simplest way possible so you're not overwhelmed by over analyzing, overthinking, overplaying your decisions. Really simple. I will have a separate video that just talks about the edge, which is at point C. But for now, thanks for watching. Like, subscribe, and share this video. And I'll see you again in the next video.